Your brain loves financial lies.
Welcome to the twisted carnival of market perception, where headlines scream louder than facts, analysts bluff with the confidence of poker cheats, and every minor dip is packaged as the financial apocalypse. The system is not built to inform you. It is built to keep you anxious, reactive, and obedient. A perfect audience for the never-ending soap opera called The Economy. Spoiler: the plot never changes. Only the graphics do. This is not education. This is psychological manipulation dressed up in suits and PowerPoint charts. You are fed fear when they want you to sell, greed when they want you to buy, and contradictions when they just need ratings. And you, thinking you are making informed decisions, are actually just starring in the longest-running sitcom on Earth, one where your money plays the punchline.
Breaking news. Panic first, facts later.
If financial journalism were a sport, the gold medal event would be manufacturing panic out of thin air. The recipe is easy. Grab a tiny blip in the market, season it with dramatic music. Plaster the screen with a blood-red arrow pointing down, and boom, instant hysteria. Congratulations, you are officially informed. Or at least informed enough to dump your investments at the worst possible time. The news industry has long since discovered that fear sells better than facts. Facts are boring, facts are slow, and facts do not trigger the dopamine rush that makes you click, share, and scream "the end is near" on social media. But fear is a goldmine. Fear makes people stay glued to their TVs, refreshing their apps like addicts waiting for their next hit. And when it comes to financial news, nothing gets eyeballs faster than a good old-fashioned market apocalypse, real or imaginary. Take a normal Tuesday afternoon. The S&P 500 dips a harmless 1.5% because, I do not know, a Fed official sneezed during a press conference. Rational interpretation. Markets fluctuate. Carry on with your life. Media interpretation. Global markets in turmoil. Is this 2008 all over again? Suddenly your aunt is calling you in tears asking if she should sell her index fund, while Twitter convinces itself civilization is ending. By the time reality catches up and the market stabilizes, the damage is already done. Viewers panicked, portfolios took a hit, and the news cycle moved on to its next doomsday scenario. This is not journalism. This is entertainment disguised as information. Anchors do not sit in front of those glowing charts to educate you. They are there to keep you hooked, anxious, and dependent. Calm does not pay advertisers. Anxiety does. And let us be honest, no one ever clicked on an article titled, "Market continues doing what markets normally do." The strategy is simple: inflate every hiccup into a crisis and every uptick into a revolution. Stock gains 3%. Investors celebrate record-breaking rally. Same stock loses 2% the next day. Panic selling signals confidence crisis. And you, the loyal viewer, are left swinging emotionally between euphoria and despair. Making financial choices with the same stability as a toddler on a sugar high. But why does this trick work so well? Because your brain is wired for drama. Evolution did not train you to calmly analyze numbers on a screen. It trained you to freak out when something looks like a threat. Back in the cave days, panic first, think later, kept you alive. Hear a rustle in the bushes? Better assume it is a lion. Today, the rustle is a headline screaming markets crashing, and the lion is your financial sanity. Spoiler alert, there is no lion. There is just a very excited intern writing headlines designed to hijack your amygdala. Financial media also thrives on the illusion of urgency. Every broadcast makes you feel like you must act immediately or face financial ruin. The window is closing, investors rushing to safety. Time is running out. The clock is always ticking. The crisis is always now, and waiting calmly is never an option. Why? Because if you stop watching, they stop earning. It is not about your money, it is about their ratings. Your panic is their profit. And let us not forget the expert panels. You know the ones. For people in suits yelling contradictory predictions at each other for 20 minutes. One says the market is doomed, another says it is booming, and a third says it is both, depending on your horoscope. In reality, nobody knows what will happen tomorrow, but the show must go on. And so you walk away more confused, more anxious, and somehow convinced that you need to check in again tomorrow, just in case the world actually does end this time. Meanwhile, the long-term investors, the ones who actually make money, are laughing. They are ignoring the headlines, calmly buying into the dips, and letting the chaos play itself out. They know the secret the media does not want you to know. Markets fluctuate, recover, and grow. But that truth is boring. It does not sell ads. It does not make you panic click a push notification at 3 a.m. It does not keep you glued to a ticker while your coffee goes cold. So here is the uncomfortable reality. The media is not misinforming you by accident. It is their business model. They want you nervous, reactive, and constantly second-guessing yourself. Because a calm investor is not profitable to them, but a panicked one is. Panic first, facts later. Preferably after the commercial break. The next time you see a headline screaming about a market bloodbath, do yourself a favor, breathe. Zoom out. Check the actual numbers instead of the neon-colored panic graphs. 9 times out of 10, it is just noise. But if you keep letting the media set your emotional thermostat, you are not investing. You are gambling with your sanity, one headline at a time. Because in the end, the only thing truly crashing is your ability to think rationally, while someone else cashes in on your fear.
Analysts say absolutely nothing useful.
If you have ever watched a financial news segment or read a market report, you have probably noticed something strange. Analysts never actually say anything that matters. They talk for hours, write pages of jargon, and confidently predict what will happen next, only to be gloriously, laughably wrong half the time. And the other half, they were still wrong, but they dressed it up with enough buzzwords that no one noticed. The dirty secret is this: analysts are not fortune tellers, they are performers. Their real job is not to predict the future, but to sound authoritative while selling you the illusion of certainty. Because let us be honest, we have no idea where the market is going, does not make for great TV, and it definitely does not justify a 6-figure research subscription. So instead, they spin stories. They slap lipstick on randomness and call it insight. Consider the classic market recap. Stocks rose today on optimism over economic growth. Translation: the market went up, and we needed an excuse. Tomorrow, if stocks fall, you will hear: markets tumbled today on fears of slowing growth. Same economy, same data, but somehow growth was both the hero and the villain within 24 hours. The only consistent truth here is that analysts must always appear to know why something happened, even if they are inventing the explanation on the spot. And oh, the predictions. Analysts love to play Nostradamus with a Bloomberg terminal. You see the S&P 500 reaching 5,200 by the end of the year. How did they get that number? A sophisticated model? Cutting-edge research? No. They pulled it out of thin air, gave it a decimal point so it looks precise, and prayed you would not ask questions. When the prediction fails, no problem. They will just revise it next quarter and pretend the first one never existed. The best part is how these analysts often contradict each other while keeping a straight face. One says oil prices will soar, another says they will collapse. Both get invited back next week, as if they did not just waste your time. Imagine if weather forecasters worked like this. It will rain tomorrow, unless it is sunny. Either way, we called it. But unlike weather people, analysts are never held accountable. If they are wrong, it is unforeseen market dynamics. If they are right, it is because of their deep insight. Heads they win, tails you lose. And let us not forget the performance art. Analysts have mastered the art of saying nothing with maximum confidence. They use terms like headwinds, tailwinds, rotation, and macro environment, vague enough to cover any outcome, specific enough to sound intelligent. It is basically financial Mad Libs. Want to try it yourself? Just say, we see potential headwinds, but remain cautiously optimistic given the favorable macro backdrop. Congratulations, you just qualified for a CNBC guest slot. But the most entertaining part of analyst theater is how their incentives are completely misaligned with your financial well-being. Analysts do not get paid for being accurate. They get paid for being convincing. Their job is to produce reports that keep you reading, keep you trading, and keep their firms in the spotlight. Whether or not you lose money is irrelevant. What matters is that you believe they hold the keys to market wisdom. keys they will gladly sell to you for a small fortune. Social media has only made this worse. Now, every wannabe analyst with a webcam and a microphone is out here dropping hot takes on why the market is about to explode or implode. These self-proclaimed experts love to dress up wild guesses as research. One guy with a chart and 3 arrows suddenly becomes a prophet with thousands of followers. Meanwhile, his track record is as reliable as a coin flip. But hey, at least he called that one stock correctly back in 2021. So why do we keep listening? Because deep down, humans crave certainty. We want someone to tell us the future, even if it is a lie. We would rather be comforted by confident nonsense than face the reality that no one, not analysts, not economists, not your uncle who trades penny stocks, actually knows what will happen next. Uncertainty is terrifying. Lies, on the other hand, feel safe. The result? People act on these expert opinions, buying and selling based on someone else's baseless guess. And when it inevitably goes wrong, they say, well, no one could have predicted this. Really, no one? Or did we just confuse confidence with competence? Here's the truth the industry does not want to admit. The market is chaos wrapped in probabilities. Analysts are not wizards. They're storytellers with expensive suits and fancy titles. If you want to survive financially, stop worshiping their forecasts and start focusing on what you can actually control. Diversification, patience, and ignoring the noise. Because at the end of the day, analysts will keep talking, the headlines will keep screaming, and you will keep being tempted to believe they know something you do not. But remember, if they really had all the answers, they would not be on TV explaining their predictions for free. They would be on a yacht, quietly enjoying the billions they made from their secret insights. Until then, treat their words for what they are: entertainment, background noise, a confidence trick in a tailored suit. And if you want to protect your money, start by doing the one thing analysts hate most: stop listening.
From market dip to end of civilization in 30 seconds.
The stock market dips 0.5%, and suddenly it is the end of civilization. Turn on any financial news channel and you would think the 4 horsemen of the apocalypse just rang the opening bell. A red candlestick flashes on the screen, the anchor's voice drops into doomsday mode. And before you know it, everyone is frantically debating whether we should start hoarding canned beans and gold bars. All this because your favorite index slipped by the cost of a bad haircut. This is the media's favorite game. Take something minor, blow it up into existential panic, and pretend they are doing you a public service. A 1% dip is not a correction. No, it is a bloodbath. A 2% dip, that is a historic crash. And if the market actually drops 5%, forget it. Society is over, pack your bags, and get ready to live in a cave. The absurdity is that markets move all the time. That is literally their job. They go up, they go down. But say that out loud and you get yawns. Call it a meltdown, and suddenly you have viewers glued to the screen like it is the season finale of a Netflix thriller. The trick is simple: speed. Financial news has to take normal, boring fluctuations and turn them into crises within seconds. If the Dow falls by 300 points, the anchors have approximately 12 seconds to frame it as the worst thing to ever happen to the economy. Never mind that 300 points today is a sneeze compared to the size of the market. Context kills the drama. And if there is one thing the media cannot allow, it is context. Context is boring. Panic is profitable. You've seen the cycle. A market dip happens. Headlines scream, investors flee in terror. Stock footage of traders holding their heads in despair plays on loop, even though those traders are probably just bored interns checking their phones. By the time you finish your coffee, you are convinced your retirement account is on fire. Rational analysis has left the building. What remains is hysteria with a fancy chart. And here's the kicker. Tomorrow, when the market rebounds, the same outlets will run with investors regain confidence as rally begins. No apology for yesterday's melodrama, no admission that they whipped you into a frenzy over nothing. Just a new headline, a new angle, and a fresh wave of emotional whiplash for your poor brain. The market is not unstable, you are, because you keep letting headlines dictate your blood pressure. Why do they do it? Because fear keeps you watching. Nobody tunes in for markets remain mostly stable. It's not TV, that is Ambien. It sells as drama, and the media knows exactly how to package it. Bold fonts, ominous music, and a lot of red arrows pointing down. The color psychology alone is enough to make you sweat. A rational 2% dip is suddenly transformed into Wall Street carnage. And you are supposed to feel like your financial life is dangling by a thread. Spoiler, it is not. But here's the part that is almost impressive. The media has managed to turn market dips into cultural events. Entire news cycles are built around a single red day. Pundits scream, Twitter explodes, and your group chat is suddenly full of amateur economists. Everyone pretends to know exactly why it happened, even though most of them could not tell you the difference between a bond yield and a yield sign. But hey, the important part is that you are panicking together. Meanwhile, the smart investors are quietly sipping their coffee, shaking their heads, and buying more shares at a discount, while the rest of the world loses its collective mind. They know that the end of civilization has not arrived. It is just another Tuesday. Markets dip, markets recover, and humanity somehow survives. But you would never know that from the coverage, because calm does not get clicks. The funniest part? This constant overreaction actually trains investors to behave badly. The more you let media hysteria set your mood, the more likely you are to panic sell at the bottom by back at the top. And repeat until your account balance looks like a sad roller coaster. The headlines are not just noise, they are financial sabotage, disguised as information. So next time you hear markets in turmoil, do yourself a favor. Check the numbers yourself. Chances are, the turmoil is a normal dip dressed up in Halloween makeup. Remember that civilization does not collapse every time the market stumbles. It just makes for better TV if you believe it does. At the end of the day, the only thing collapsing in 30 seconds is your sense of perspective. And that, my friend, is exactly how they like it.
Fear, greed, repeat.
If the financial markets had a theme song, it would not be Beethoven. It would not be jazz. It would be a circus tune on repeat. Because really, the entire show runs on only two notes: fear and greed. Investors like to pretend they are rational, data-driven, disciplined professionals. Reality check. They are emotional slot machines, reacting to headlines, charts, and social media posts with all the self-control of a toddler in a candy aisle. The cycle is as old as money itself. First comes fear. A headline screams, recession looms, and suddenly everyone is dumping their stocks like they are radioactive. Panic spreads faster than a rumor in high school, and portfolios shrink overnight. Never mind that the recession is still hypothetical, that no one actually knows when it will arrive, or that half the experts cannot even agree on the definition. Fear has spoken, and fear does not wait for details. Then, just as quickly, comes greed. The market bounces, and suddenly, we are all financial visionaries again. Forget last week's meltdown. This is the rally of a lifetime. Every stock is the next Amazon. Every dip is a generational buying opportunity. Your cousin's dog groomer's TikTok about a penny stock feels like sage advice. Fear evaporates. Greed takes the wheel. And once again, we are convinced that early retirement is only a few trades away. And then it happens all over again. Fear, greed, repeat. The cycle never ends. You would think that after decades, no, centuries of bubbles and crashes, people would learn. Spoiler, they do not. Because fear and greed are not just emotions. They are business models. They're the fuel that keeps Wall Street's machine humming, media companies paid, and ordinary investors broke but entertained. Financial media thrives on this cycle. One day they terrify you with graphics of flaming dollar bills. The next day they seduce you with headlines like Dow surges to record high. It is emotional whiplash served daily. You, the loyal consumer, eat it up, oscillating between panic selling your future and mortgaging your sanity for a chance at quick riches. The truth is, markets are not inherently chaotic. Investors are. And the more you chase these emotional swings, the more you guarantee one outcome. You lose, someone richer wins. Wall Street knows this game too. Brokerage apps literally gamify your fear and greed. Red screens, loud buzzers, and sad little arrows push you to sell when you should not. Green fireworks and dopamine-triggering notifications nudge you to buy when it makes no sense. They are not teaching you to invest. They are teaching you to react, because reactions generate fees, commissions, and endless churn. Your panic and your greed are not accidents. They are features of the system. Here is the uncomfortable truth. Most investors are not defeated by the market itself. They are defeated by their own emotions, expertly exploited by people who know exactly which buttons to press. Fear convinces you to sell low. Greed convinces you to buy high. Rinse and repeat until your retirement dreams are downgraded to maybe I can afford a decent couch. But let us not act like this is new. Fear and greed have been running the show since the days of tulip mania. People mortgaged their homes for flowers. Entire fortunes were lost on the belief that a tulip bulb was worth more than gold. Was it rational? Of course not. Was it predictable? Absolutely, because the cycle never changes. The objects just get updated. Tulips, railroads, .com stocks, crypto memes, different centuries, same stupidity. So how do you escape the brutal answer? You probably will not. Not completely. Because you are human, and humans are wired to fear losses and chase gains. The trick is not to eliminate the cycle. It is to recognize it, laugh at it, and refuse to let it dictate your every move. That means tuning out the hysteria, sticking to boring strategies like diversification, and accepting that building wealth is not supposed to feel like a roller coaster. Of course, boring but effective does not make headlines, will not impress your friends at parties, will not make you feel like a genius when the market rallies for 3 days straight. But it will keep your money safe from the oldest scam in history, your own emotions, dressed up as financial wisdom. So remember this the next time you feel the urge to panic sell or FOMO buy. The market is not out to get you. The system is not conspiring against you. The real enemy is staring at you in the mirror, bouncing between fear and greed like a puppet. And until you cut those strings, you are not investing. You are just paying admission to the same circus everyone else is trapped in. Fear, greed. Repeat, the greatest show on earth, and the most expensive ticket you will ever buy.
The cult of headlines. Worship now, regret later.
If there is one religion stronger than politics, football, or celebrity gossip, it is the church of financial headlines. Every day, millions of investors bow their heads, open their apps, and pray to the gods of clickbait for guidance. Forget strategy, forget fundamentals, forget common sense. If a headline says it, it must be true, right? Wrong. Financial headlines are not divine revelations. They are marketing gimmicks wrapped in capital letters. They exist for one purpose: to grab your attention long enough to sell ads, subscriptions, or whatever miracle stock some firm wants you to buy. They are not written to help you. They are written to manipulate you. And the sooner you realize you are being played, the sooner you can stop throwing your money into the collection plate of this ridiculous cult. Take a look at any business section. Markets soar on optimism. Optimism about what? Nobody knows. Stocks plunge amid fears. Fears of what? Who cares? Headlines are never about nuance. They are about drama. The best part, they recycle the same words endlessly. Soar, plunge, surge, collapse, rally, bloodbath. It is like a never-ending soap opera where the script never changes, but somehow people keep tuning in. Why does this nonsense work? Because people want shortcuts. Reading earnings reports is boring. Learning about fundamentals takes effort. But a headline, that is easy. One quick sentence tells you how to feel about the market today. Optimistic, terrified, or smug. It is financial fortune-telling in bite-sized form. And you gobble it up because doing the actual work would require attention span. The problem is that headlines are not just oversimplified. They are dangerous. They push you to act immediately without thinking. Markets in crisis makes you sell at the bottom. Historic rally makes you buy at the top. You are not investing. You're just following instructions from a glorified marketing department. And the people writing those headlines, they will never pay for your mistakes. That bill is yours alone. The cult gets even better when you realize how contradictory the headlines are. One outlet screams tech stocks doomed, while another gushes tech stocks poised for massive comeback. Both cannot be right, but both can keep you hooked. And when you are confused, you do what most investors do: act emotionally. The cult thrives on your uncertainty, feeding you mixed messages until you are trading like a caffeinated squirrel. And let us not forget the prophets of this cult. The so-called gurus and pundits quoted in every other article. They give bold, sweeping statements like Bitcoin will hit $500,000 or the housing market will collapse by next year. When they are wrong, and they almost always are, nobody remembers. When they are right by accident, They plaster it on book covers and speaking tours for the rest of their careers. In this cult, accountability is optional, but confidence is mandatory. The real genius of financial headlines is how they hijack your biology. Fear grabs your attention faster than facts ever could. A headline saying, "Market's stable, nothing much happening," might be honest, but it would put you to sleep. Markets collapse and bloodbath gets clicks, panic, and no-joke trades. It is not journalism. It is psychological warfare dressed up as newsprint. And do not think you are immune. Everyone believes they are too smart to fall for it, until they do. That push notification buzzes your phone. You glance at the words Dow plunges, and suddenly you are questioning your portfolio, like it just cheated on you. You sell, you panic, you regret. Congratulations, you just tithed at the altar of the headline cult. Here is the brutal truth. If you are making decisions based on headlines, you are not investing. You're gambling with someone else's script. You are a background character in a play designed to make you act on impulse, while someone richer pockets the profit. They write the headline, you write the check. So how do you escape this cult? Step 1. Stop worshiping headlines like they hold secret wisdom. They do not. Step 2. Remember that boring, factual information is your friend. Step 3. Realize that if a headline makes you feel an immediate urge to act, that is the clearest sign you should not. The market rewards patience, not panic. The next time you see markets in chaos or investors rejoice, remind yourself that tomorrow, the opposite headline will probably run with equal confidence. Do not worship it. Do not follow it. Laugh at it, because headlines do not predict the future. They manipulate your present. In the end, the cult of headlines has one commandment: worship now, regret later. Break free, and you might just keep your money. Stay faithful, and you are not an investor. You are a disciple funding someone else's empire.
The market is fine. You are the problem.
At the end of the day, the market is not collapsing every 5 minutes. Your perspective is. Headlines are not truth. Analysts are not prophets. And your emotions are not a strategy. Yet here you are, worshiping clickbait like scripture, panicking at every blip on the chart and calling it investing. Newsflash, you are not building wealth. You are financing someone else's yacht. The cycle will not stop. The media will keep screaming, the analysts will keep bluffing, and the herd will keep sprinting toward the cliff. The only question left is whether you will keep playing the fool. You can unplug from the circus and think for yourself. Or you can stay addicted to panic porn until your portfolio looks like a bad joke. Either way, the market will be fine. The real problem, and the only fixable one, is you.